Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jeff deGraaf joins us now.
Is that a Martin guitar behind him? Stage right? I don't know.
Yes. That looks like almost like they're on the edge of a D35.
0018 maybe, I think.
Maybe 0018, we'll it's a very Clapton-ish. Jeff deGraaf joins us now in the equity markets. What are you learning from Neil Dutta? How do you take Dutta economics, the great optimist, now very cautious? How do you fold that into a market belief, Jeff deGraaf?
Well, it's a great question, Tom. I think it's important that we distinguish, and David hit on this before, the difference between economics and an economic call and a market call. And while they're not 100% independent by any means, they're certainly not brother or sister. We'd say they're probably second cousins. And so, a lot of the data that we see, a lot of the trajectory that we see in that data is reflected in the market. And then the question becomes, okay, well, at what point does that become fully priced? And is the market starting to look ahead from those things? So right now, I would say that's, Neil and I are more on the same page than not in terms of the market's message, the economic message. I do think that there's a tactical call here that we have to be cognizant of. But, overall, from a trend perspective, those two things are aligned.
I mean, my head's spinning. I had Margaret Franklin of the CFA Institute on. And then I got the IMF headlines, and I got Tom Orlick of Bloomberg saying it's a paradigmatic shift. In our equity market thinking, Jeff, is it thinking as usual, or is it a paradigmatic shift in how we approach stocks?
Well, that's a great question. So what you're really asking is this time different? And I think what we can conclude is that from a sentiment standpoint, all those things that the IMF is talking about. I mean, the question that David asked was a great question, and I would just simplify that and say, does the IMF make you money? Because that's really what I'm trying to do here, right? I'm a speculator. There's no doubt about that. So I'm not trying to call GDP. I'm trying to look at where the S&P is likely to be in the next 1, 3, 6 months. And so when I look at sentiment, this is really a reflection. What the IMF is doing is really a reflection of the policy uncertainty, which has spiked, a reflection of some of the correlations that we're seeing, which are spiking, a reflection of just the general sentiment environment that's out there. So I would put those forecasts in that bucket. And I think the important part of that is, what do those forecasts do? Well, they get people thinking differently, and that includes policymakers. That gets them thinking about, hey, how can we avert this? How can we soften this blow? What can we do to minimize this? And so that's where I think you want to be thinking a little bit differently here, is what the reaction function is when everybody starts to pile up on one side of the boat. There's still fish on the other side, and that's what we're looking for.
Jeff, how do you look at this kind of moment-to-moment market? And that's what it seems to have been here over these last few weeks. And we talked at the top of the show just about this perhaps distracting conversation about the position the Fed chair is in right now and what the president's saying. But we know that is making its way into how the market is moving. How do you kind of focus in a more laser-like way on the technicals amidst all of that? So yes, it's a distraction, but how do you see through the fog of that and sort of chart a path forward?
A great question. And we say this all the time. It's in our disclaimer. This is a probability, not a prediction business. And so what we're really trying to do is find where the mismatches are in probability and prediction. And I think one of those that really jumps out to me, you can look at the poly market as an example of, quote unquote, will Trump remove Jerome Powell in 2025? There's right now about a 21% chance of that given the poly market. Now, obviously, you've got players here. This isn't a perfectly well-distributed probability distribution. But if you think about that, 21%, the way I want you to think about it is that's about the equivalent of you having a 16 at a blackjack table and the dealer having a 10. That's not a great place to be. In other words, I'd much rather be in the dealer's hand, which says I'd much rather be in Powell's position, that I'm not going to get fired and that I'm still going to be there. And that's the way that we think about that.
A lot of America, Jeff deGraaf with his folks at Renaissance, I should say, Renaissance Macro here, with futures up 55. We welcome all of you on your commute across the nation. Got some good equity chat coming up here. Is Brian Belski, is Brian Belski still scheduled with us as well? Brian Belski's, he's leaving the beach in Florida. He's down there early. deGraaf, we're not on the beach like Belski. Jeff, that's all great and well, but a huge body of our listeners don't want to speculate. They got a retirement account. How should someone in conservative money, cautious money, actuarial assumption money, how should that person move in this paradigmatic shift?
Well, look, I think we run allocation models. We've run one for about 5 years now, and we look at it on a dynamic basis. Where it's kind of an optimization problem. But I think the best way to explain that from kind of a generalist standpoint is in being in an athletic stance, right? You want to be able to move forward, sideways, backwards, whatever the case may be. And right now, our allocations are about 35% stocks, 25% treasuries, and about 30% cash. With the remainder in some commodities. And that's really a reflection of the trends that we see, the deterioration in the data that we're seeing, and what we think is likely to happen going forward. And part of that, given the uncertainty, is that large commitment to cash. Now, we try to solve for sharp ratios. We try to solve for risk-adjusted returns, not just absolute returns. And so that's one of the reasons why this is a little bit more balanced of an approach. But we certainly have seen our allocations to equities come down here, really been cut in half in about the last, I'd say 3 months at least, probably 2.5 to 3 months.
David, I didn't realize this. On a weekly chart, Apple's down 33% max. Wow. That was the maximum drawdown. I had no idea that was that much agony out there.
Jeff, where are you on the topic of American exceptionalism? A lot of folks pouring one out for American exceptionalism, given all of this. How are you looking at it? How much longevity does it have as you see it?
Look, I think it comes down to where is capital treated best. And right now, clearly there's some question as to how capital is going to be treated here in the U.S. But I think when we take a step back, take a deep breath, kind of get through the summer, see what's going on, hopefully this is, I don't want to say resolved, but at least there's a little bit more clarity in this fog of war here. I think people are going to look back and say, look, where do we have the highest return on invested capital? Where can we really outkick our coverage, if you will, given the risk? And I think that's going to take a long time to shift that away from the U.S. And so I think there's a sentiment environment here that's certainly percolating. It's having an impact. I mean, you really are getting into situations with rise in treasuries, with the Fed likely to cut rates at the next meeting, and the decline in equities and the decline in dollar. I mean, that's taking you back into the Smithsonian stuff of 1971. So, it's a pretty unusual environment. But I do think that when the dust settles, people are going to look around and say, hey, where's my money going to return the best for its risk profile? And I think that's still going to be the U.S.
Are we in a bear market?
We are.
You trying to tee up Belski here?
I am. I just, I thought I'd get a longer answer from Jeff. I just went down in flames there. Discuss, Jeff deGraaf.
I can elaborate.
Are we in a bear market?
A bear market is not about being down 20%. It's not some magical number. It really is about the combination of the increase in volatility, the decrease in returns, and what that's happening on a trend basis. And those are all sloping downwards now. So in our book, that is the definition of a bear market. And that really kicked in about a month ago. So this is not a new phenomenon. This has been something that's at play. And I do think that that's important as we think about it from a longer term perspective. The question is has sentiment outdone itself in the very near term to get a really nice rally? That's where we are. We think we can rally back to at least 5,500, probably closer to 5,700. And then the question will be, how did we get there? Did we get there with momentum? Did we get there with a change in the attitude? If we didn't, then that's a rally to sell.
Always good to ask the follow-up, Tom. That was great.
Huh?
Always good to ask the follow-up question.
I like how he changed the way he asked.
See, deGraaf, what you don't understand is when Gurr's in the press conference at the White House, he's like looking for the third follow-up question. Those days are gone, aren't they?
Gone. You might have missed this, Jeff, but Tom noted that during the hockey game last night, gold hit 3,500. He got a push alert or something like that when you were watching this game. What do we take away from that, Jeff? Gold hitting that level. We've seen this amazing trajectory that gold has had over the last few months. 30% this year. What do you make of that? I guess that's my dumb question I'm going to ask you.
Well, I don't think it's dumb at all. I think, I think that's a reasonable response to sanctions that have been in place for a long time, kind of the weaponization of the dollar, the U.S. financial system. I mean, look, if we were on the other side of this trade, if we weren't U.S. citizens or the U.S. government, I'd be thinking about the same thing too, right? How can I make sure that I'm not just totally dependent on U.S. dollars and treasuries? So that does make some sense to me, no doubt about it. That trend's been in place for a while, though. I mean, our trend models have been bullish on gold for at least 18 months. It's probably longer than that. I think what's interesting about gold right here is when we start looking at some of our rolling alpha models and some of the things that we look at historically, we are getting into rarefied air. So we don't yet quite have it from a sentiment standpoint on the ETF inflows. But the one thing that we will watch when it comes to extremes in trend, which we're getting very close to, if not there for gold, is the sentiment environment so robust that it says to us there's a buyer's frenzy and we want to take a step aside. Right. I suspect that we're within days of weeks of that. So I actually think that's a pretty good spot to start to let some of this go. Again, within the context of an uptrend, so it's more of a tactical call, but I think it is getting kind of into that frenzy zone.
Too short an answer. I'm sorry, Jeff deGraaf. Is Mag 7 broken? I
think you have to strip it out, but for the most part, the trends for Mag 7 are bearish, and we haven't seen anything from a momentum standpoint, and really not even from a sentiment standpoint yet for those individual names to say that the trend has exhausted itself. I would say for semiconductors, for the first time, this was about 3 weeks ago, maybe 2 weeks ago now, our seller's frenzy started to fire in semiconductors. Obviously, the weakness in NVIDIA helped that. That's a stark contrast to where we were 9 months ago, which was a buyer's frenzy. We were warning clients that the trend, exactly like gold, the trend was too frothy. And I think one of the important parts of this from an overall sentiment standpoint is that you've got this now repudiation of the sky blue narrative that was AI. So people are now going from protecting themselves in semis to actually trying to profit on the downside. That's a really important psychological change, and that tends to be a bullish psychological change.
Jeff deGraaf, thank you so much. Renaissance Macro Research is a really, really great briefing there.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, someone who's enjoyed that humility, Brian Belski, Chief Investment Strategist at BMO Capital Markets. Brian, how are you framing out your inherent optimism on equities given this time we are living?
Thanks for having us. It's tough to be bullish now, but as we always say, pride brings disgrace and humility generates wisdom. And you just brought some humility my way, because the very first stock that I analyzed at William O'Neill and Company for William O'Neill was 3M. He literally walked me over to the filing cabinet, made me pull out the file and read it. So it is Minnesota Mining and Manufacturing.
This is
Continue. Isn't that cool?
Yeah.
So I've been thinking a lot about this, and the binary reactions of investors have never been greater, number one. Number two, I think this has a lot to do with how we react to bullet points and emotions and things like that. And I'm going to make a parallel, and it's probably not going to be very popular. So I think this is very parallel in terms of how we're reacting to what's going on in the stock market to COVID. Now, clearly, COVID was a fright. It was a once in every 4 generation event in terms of a pandemic, but the emotions in COVID are similar to, in the fear of COVID, are similar to our personal feelings with respect to what's happening politically. Then the other thing is, many of my compatriots, colleagues, and competitors are not staying in their lane. They've become now amateur psychologists that are diagnosing personality disorders, where they should actually be focusing more on what's happening in the economy in terms of in earnings. Here's what we know. We don't know exactly how long this is going to last. We've already positioned, we meaning consensus, that this is going to take years and years and years and years to unfold. So I believe that the majority of portfolios, strategists, economists are already positioned for the worst case scenario. What we believe in our standing in terms of the investment strategy group at BMO is this could all be over in a matter of days. We're not trying to be Pollyanna or flippant. We believe in the inherent strength of the U.S. economy, the U.S. stock market, and we still believe that we have the best assets in the world. And we're going to take negativity to add to those assets.
Bronze it. David, get a question in here before the market open. I'm going to come back because, folks, this is my third rail right now that Belski addressed. David Gurr with a question.
Right, we've got about a minute till the market opens. But yeah, so I know that you've revised your year-end target. Are you doing that simply because of historical trends where you think things are going or could go? Just in the minute we have here, explain why you decided to make that revision down.
Well, again, with much humility, we have to be much more realistic, especially given the drawdown that we've had, David. And I think to have a 35 to 40% move from here to get to 6,700 would be very difficult. Can we get a 20 to 25%? Absolutely. And that is based on historical standards.
With us from BMO Capital Markets, Brian Belski. Brian, you know I'm on your side on this. We've had a number of guests this morning go back to Keynesian theory of 1949 or 47. And use the dreaded word paradigm. When I see that word, Brian Belski, I circle it with fear. Why is this not a paradigmatic shift in the markets?
I don't think it's I think the market actually is acting like it's a paradigmatic shift. And oh, by the way, I had the very good fortune of being in Europe last week, Tommy, and talking to those great investors that have had wonderful returns if they've been investing in European stocks. And to be clear, Europe investors have not really liked U.S. stocks wholeheartedly and objectively since the year 2000. They've been reluctant buyers of U.S. stocks the last 10 years. And so they're taking victory laps with respect to what's happening now. But I think we need to think more objectively about this, Tom. I think what's happening is more of a reversion to the mean. If I go back to my Merrill Lynch days, I think we're reverting to the mean. I think, again, to go back to what I said in the beginning, we're making binary decisions in terms of we're not going to go all this way in terms of going back to this massive paradigm shift that people are thinking positioned for. I think this is simply being positioned to a shift to the mean because we went too far the other side.
Brian, we had Jeff deGraaf on right before you. So speaking of binary, let me set this up 1-2. Tom asked him, are we in a bear market? And he didn't waste more than half a second in saying yes. How about you? What's your read on where we are? Would you use the same name?
Well, Jeff's from Michigan, so he has the Midwest sensibilities. So I don't know yet. So here's what I would say, and here's what we actually wrote in a published research report. It doesn't matter if we're in a bear market. And again, we all like to put labels on. Let's go back to what we said in the report. Doesn't matter if we're down 10%, 15%, or 25%. Again, we don't like it when people lose money. I think it's terrible. The market was a little bit frothy heading into the beginning of the year. We know that. However, why doesn't it matter? Because when the market bottoms, and we do think we're in a bottoming process, we don't go straight down or straight up. It's a process. Typically and historically, when we have these types of exacerbated moves to the downside, 12 months out, we're now up an average of 29.4%. So give me a 20% rally still gets us to that 6,100 target by hopefully closer to year end. Even if we don't get there, I think we'll get closer to that than most people think. So again, I think that we'd love to put labels on things. By the way, too, and I know Jeff would probably agree to this. I've known Jeff for a long time. Is that how many people sold at the peak? Huh? How many people sold at the peak? So a lot of this is peak to trough type analysis. And again, that's more academic than anything.
Brian Belski, thank you so much. Greatly appreciate it. Let's do it again and just appreciate those comments.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is exceptionally well timed. Alicia Garcia-Herrero out of Hong Kong, when the Natixis chief economist for the Pacific Rim, if you will, joins us right now. Alicia, I'm a little upset this morning, and I'm playing off of Greg Ip, who I think was really terse and to the point with the Wall Street Journal. The news that we saw in the last 4 or 5 days was Japan had quote-unquote negotiations with the White House, except they weren't negotiations. And then 2 days later, China has come out and said anybody that has negotiations that harm China, that will not be accepted. To me, there's a misunderstanding of tariff war dynamics, trade war dynamics in the Pacific Rim. Discuss that. How fragile are the negotiations right now?
Well, I think the Trump administration probably thought this would be easier. So what was the strategy? I threatened to the point of actually imposing tariffs on everybody, so that they then realize how dangerous this game is and they decouple from China. But this came quite late, in the game. Why? Because many of these nations already depend massively on China. Japan is one of the least dependent, and still. So for Japan, for South Korea, the US is a larger export market. But the problem is from the import side. So if you are Vietnam, which is an extreme case, you just can't export without China. You just can't do what the US is asking you to do. You can't impose tariffs on Chinese inputs, on Chinese intermediate goods, without which you cannot export to the US. So in a way, the US is requesting something that is not feasible for a lot of Asian countries. I would say Southeast Asia,
Right.
ASEAN. That's why it is not going to work in the way the Trump administration expects it to work.
Right. David?
You know, I'm curious. We've seen the Chinese currency weaken. We've seen the Beijing government allow that to happen over these last many weeks. How do you see that playing out going forward as we kind of look at the way in which China is, I won't say weathering, but navigating this stalemate here with the U.S. government?
Okay, so China has a few tools to, I wouldn't say withstand, but mitigate the shock. The shock is huge. Let's face it, this won't be said in China, but it is a huge shock. It is even more so if the US ultimately imposes tariffs on countries through which China is going to the US, Vietnam, Thailand, Malaysia. One way to go about this is what China has already done. Actually, China's response, post-COVID response to its own weaknesses in 2022, 2023, all the way to September 2024, was to weaken the currency, to allow the weakening. They didn't need to weaken themselves because the market was already on a weakening cycle because the economy was really not doing well. So capital was leaving China. And also US rates were very high, and therefore the interest rate differential was attracting capital. So they are now doing the same thing, but very carefully, because they know the US is watching, which wasn't the case before. I think they could do much more if needed, and that would create a competitive devaluation in Asia.
Alicia, thank you so much for joining us. She's with Natixis on the Pacific Rim, Chief Economist for APEC, Alicia Garcia-Herrero.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now from Australia and the Peterson Institute, Warwick McKibben. Are they going to work, Dr. McKibben? I mean, just simple. The president makes it sound so easy, so simple. Are we actually going to bring in revenue from tariffs?
Great to be here. I guess the question is, will they work? Depends on what the objective is. If the objective is to slow down economic growth, yes, they'll achieve that. If the objective is to bring in revenue, yes, they will bring in some revenue, but by our estimates and other estimates, the revenue is nowhere near as great as advocates of tariffs might suggest. It's a very narrow tax base, so you have to have a very high tax to get any revenue.
Do you indicate or see that there's anyone within the Trump orbit that can explain what you just said to the president? Is there anyone that can explain this to Donald Trump?
Well, I haven't seen any explanation that makes sense. I think the calculation that might have been done is how many imports are there in the US at the moment? It's $3 trillion multiplied by a tariff of 10%. How much revenue do you get? Well, you get $300 billion a year for 10 years is $3 trillion. So that's a simple calculation. What it ignores is that people will stop buying imports because they'll become more expensive. People will shift their consumption bundles. Inflation will go up. The economy will slow, and you'll lose revenue from your corporate taxes and from your household income taxes. So when you net all that out, you get a lot more offset than you expect. And I haven't seen the calculations of offset being produced by anyone in the administration.
I was having some fun a moment ago talking about stochastic models, and you're famous for one with Jeff Sachs. Tom mentioned him just a moment ago. Can you just talk in plain terms about how you conducted your analysis and sort of what variables are there in sort of coming to some conclusion about the effect this is going to have?
Yeah, what we've tried to, and that's a good question. What we've tried to do is bring both the financial parts of the world economy, the links between countries through asset markets, exchange rates, bond markets, together with production networks. So we're modelling the real economy, how resources flow within the US economy and between the US and China and other countries. And so we try and map the physical economy and the financial economy and their interaction into a very, very large, complex system, which is based partly on historical relationships and partly on observed events such as German unification, such as NAFTA, such as events where we saw something occur and we see whether our modelling framework can replicate what had happened within a reasonable degree of confidence. And then we use that framework to project scenarios for central banks, for corporations, for governments, simple questions as well as complex questions like the tariff war.
We were talking about the IMF's revised forecast this morning, and something we heard from our chief economist, from Tom as well, is this being a kind of paradigm shift. And I wonder sort of how you are thinking about what this portends, what's changing about the global economy vis-a-vis what the Trump administration has announced in terms of trade policy.
Well, we've been seeing this transformation going on for decades. We've seen the center of global economic activity moving from Europe and the US to Asia. And so what's been announced is a vast acceleration, but still moving in that direction where the balance of economic power is shifting away from the advanced economies as we know them today. So this is actually a very large economic adjustment. It accelerates something that's already happening. I guess one of the interesting things is the geopolitical adjustment hasn't caught up with the economic adjustment we've been seeing. And so the US is very overweighted in the international institutions like the IMF and World Bank and UN. I think that doesn't really bother the Trump administration at all. In fact, they're trying to move that away from the current arrangements as well. But this is a very major event in world history, I would say.
Dr. McKibben, thank you so much. Warwick McKibben there with the Peterson Institute in Washington, writing with Adam Posen, Chad Bone, and others. Just can't say enough about their output in the recent weeks.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
In the year, there are few people I want to talk to more than Margaret Franklin. Her institution changed my life, joining us, not from Charlottesville, Virginia, but I believe in Washington today, driving steadfastly the Chartered Financial Analysts Institute, the CFA Institute. Margaret Franklin joins us right now. Margaret, the institution of 170,000 people, the rite of passage that it is, are you beyond COVID?
Well, Tom, I am thrilled to say we are beyond COVID, and in fact, we're 200,000 members. And COVID gave us the opportunity to really evaluate and I would say improve the CFA program so that candidates and charter holders are as ready as ever for what lies ahead. And it's, of course, interesting times for investors.
It was hugely difficult. Like at one point, India was shut down. I can't remember the details, but literally for the level 1, level 2, level 3 exams, nations couldn't take the test. Is it smooth going now, and particularly the test taking on the Pacific Rim?
It is smooth going, and you're right. It was completely disjointed and inordinately disruptive for candidates. When COVID hit, we were doing paper-based tests, and we're now, of course, completely computer-based. And so it is seamless, and we have more reach than we ever have before. Right. So in more markets and making it more accessible for candidates to take their exams close to home.
Margaret, David wants to get in here, but I have to ask, are you kidding me? A computer-based CFA exam? There's something about the pain in your hand.
You can still bring your slide rule, Tom. I'm sure they would allow you in.
I have on my desk my Hewlett-Packard 12C with my Margaret Franklin yellow CFA dot. What has it been, Margaret, like going from handwritten agony over to computer exams? Do the people like it?
Yeah, they do. And of course, you won't be surprised, though, Tom, they still feel the same amount of agony because the quality, the rigor, and of course, the content are the tough part. So I think it's just equally as tough. A new medium.
David, ethics is not the same computer taking.
Margaret, I see you have these specialized pathways now, private wealth, private markets. and the traditional portfolio management path. I'm still waiting for the pedantic amateur radio host path, which I'll continue to wait for here. But explain how that works and sort of what that leads to. Is it all leading to the same thing, all to the same designation?
Yeah. So it does. It's all CFA. It's Margaret Franklin, Tom Keene, comma CFA. But we were able to, when we did that audit, and we used the COVID period to assess the program, we were able to keep the entire core of the program and then offer pathways in level 3 for half of it to really align better with candidates' desires in really the core areas that are of interest: private markets, private wealth, and then of course traditional portfolio management. And that coincided with a number of changes we made to the program, including allowing college students to begin 23 months away from graduation so they could be really prepared for the market. And in addition, we added practical skills modules. We did an assessment with employers, and they were very keen to share that they valued the rigor, the quality, and the knowledge, but they wanted candidates to be much more job ready. And so we added our practical skills modules, and I think that has been very well received, as well as, the way we know that learners learn is changing. So we've set candidates up for success with a great learning ecosystem and great ways for them to learn.
The curricula is better. It's much more formalized now. Folks, it used to be a 3-foot pile of books that you'd try to get through. The accounting book alone, John Deere Accounting, would kill you. So the curricula is better, Margaret Franklin, but is it, the kids, are they coming out as smart equally, or is it actually on a quantitative basis more rigorous now?
Well, I think, Tom, if you and I went back to go write it, we would find it pretty difficult because, as you know, the course is very, very comprehensive.
Yeah.
And so there are things that when we wrote just weren't part of the curricula. But the curricula, of course, keeps up with what the employers are looking for, because we have always on assessment through our practice analysis. So I'd say it remains very challenging. About 1 in 7 who start it will complete it. And the assessment and validation of the candidate's knowledge, skills, and ability is a critical component. And that's what differentiates it from so many programs and why it remains as valued today as it did 60 years ago.
One final question. If Michael Mauboussin was here and his contribution to the, Abby Joseph Cohen, everybody that supported the program here over the years, the great George Vanderheiden years ago at Fidelity. Margaret, where in God's name is CFA level 4 on derivatives in the Greek letters? Bruno DePierre emails in from Bloomberg Derivatives and says, Margaret, when do we get level 4 derivative Greek letter strategy?
Well, everybody who's writing and everybody who has their charter knows that I can confirm we will not be doing a level 4.
Yes.
And Tom, I will say you mentioned Frank Fabozzi earlier before we came on the line. So you've got all the legends there counted.
Well, we do. Margaret Franklin, thank you so much. And again, the level 3 pass rate, Catherine Doherty writing it for Bloomberg today, 49%. And David, what you heard there, 1 in 7 that start it, get through it. It's
what is the former surveillance intern pass rate? You keep tabs on that?
It's pretty huge, actually.
I believe it.
It's like, we're humbled by that. Margaret Franklin out of Charlottesville, Virginia. A moment there, an annual review of the Chartered Financial Analyst designation.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Lisa Mateo, what do you have today, Lisa?
Oh, all right. Into the newspapers. Okay, so we've all ridden in an Uber, right? But have you signed up for the Uber One service? Okay, it costs $9.99 a month. The company says it's going to help you save some money on ride bookings, food deliveries. So here's the thing. The FTC is saying that canceling the subscription is too difficult, so it's filing a lawsuit now. So they promote it, right? They do all these push notifications while you're using the app. But to cancel it, here's what you have to do. You have to go through about 7 different screens that require at least 12 different actions. And they say it's so tough that there's even these tutorials that have been sparked online, getting so many things, so many views. And then some consumers are even saying they're getting charged for it without even signing up for it. So that's the problem. It's Uber One. I do not have that service, but
I see. I'm getting the push alert right now.
you see.
I don't have
that
it though.
simple. They
I haven't
will
done
push it out to you
that I know of.
But to cancel it, they're saying is a little bit too tough. Uber says, it's clear and simple. You can cancel it, but
This is part of the
it's a
ancient
lot of
technology.
steps.
It's like you get an email and you try to unsubscribe.
Can't, yeah.
And so
Right.
many places are wonderful about it. Okay, goodbye. And then some places, you can just tell they just do not want you to go.
Yeah, like some of the streaming ones are pretty easy. You just kind of click a button and you can unsubscribe.
Okay.
But yeah, it's Uber One.
What do you got next?
Okay, I thought we were done talking about this, but apparently not. We're talking about egg prices again.
Aha.
Not as high as they once were, but they're still high. Of course,
And
there's
out
the
of stock.
bird flu, and some out of stock. But the Financial Times is saying the makers of those plant-based eggs,
Oh, boy.
they're kind of trying to take advantage. So they're expanding production, launching these fancy marketing campaigns. We're talking about I think they're called mung
Mung beans.
bean-based liquid eggs.
It's why Gura's here
Yes.
today.
The Mung
Please,
Bean
David.
report.
Please, illuminate.
I've never had a
tried.
plant-based egg.
You haven't.
And I've broken bread with you many a time, Tom. I've never seen you order vegetable-based eggs. I've seen you order a
Didn't we do
vegetable
this?
once,
Come
I
on.
think, in
we
history.
had
but-
Beyond Meat, and now we have
Yes,
Beyond
so
Egg.
now you
Yeah.
have Eat Just. It's the maker of Just Egg.
Just egg.
Just Egg. So that's the one that their sales of 5 times higher than, over last
Who
year.
comes up with these ideas? People, fancy people from Cornell? I don't know.
The people are looking for alternatives. So
save
they
a
have to
little bit
meet
of
the
money.
consumer demand for it. So,
Has
Just Eggs.
Beyond Meat gone away?
No, still around.
No, but that's the thing. Is this going to go away because it's not as popular? Like the Beyond Meat
Those
kind of
prices
went
are going
out.
to go down, I assume.
Why are
Yes.
eggs still out of stock? Is it just a demand thing?
Still, the bird flu is
Birds
still
take
an
time to
issue.
grow.
So yeah, it does.
Okay.
It
I
does,
was
it does.
surprised. This weekend I couldn't get eggs.
Well,
Little-
it was
Still
Easter.
couldn't.
It was Easter.
That's
People
true.
were boiling them up.
Well,
That's
true.
true.
Yeah.
True.
We
But
use potatoes.
Good.
You can use other substitutes like applesauce, mashed bananas, yogurt, chia seeds. See, that's what I
Chia
use in
seeds.
baking.
The mung bean and chia seed morning here.
It's delicious.
Is that how you say it? Chia?
Chia.
Chia,
Yeah.
yes.
Next.
Okay, this is actually an interesting look. So the Washington Post had this into the changing economics of college football affecting the NFL draft because players have the option they can make more money by staying in college with the NIL deals, the transfer portal, things like that.
interesting.
So they're putting off entering into the draft. So they gave this example. So there's after 5 years, a Georgia quarterback, Carson Beck, he said in December he's going to enter the draft. But then in January, he came back and he said, you know what? I'm going to stay in college. He will earn an NIL package at Miami, estimated to be at least $3 million.
$3 million.
For a college kid. So not too bad. And for him, it made sense because he had an injury. Like his performance wasn't as well as the previous year. So it kind of made sense for him to stay in college a little bit longer. But they spoke with agents and they're saying it's a different world.
We protect the children of the innocent here, but you are living this, Lisa Mateo. You have a very gifted child.
Yes.
Basically, at your young child's age, it's professional sports, isn't it?
Yes, but for my child to make $3 million, that's kind of scary.
Well,
I
if
don't
she
know,
takes,
it's so
if she,
young.
That's one word
if she
for it.
makes 800,000, Lisa Mateo,
Yeah, that's good.
will cash
Yeah.
that check.
We hope you're still here.
Yes,
after
Lisa
she's making $3
Mateo,
million.
thank you so much for the name, image, and likeness offspring, we should say, that's doing better than good in the sport of her choice.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.